Hi everyone! The start of July turned out to be relatively calm. Last week there were no sharp price fluctuations on Wall Street. The benchmark indices did not show any notable dynamic. Nevertheless, all three stock indices ended last week in the green. The new week is going to be more eventful and volatile. More companies are going to unveil their second quarter earnings reports. The earnings season is already in full swing. Apart from that, traders are expecting important economic data. Some analysts reckon that the upcoming session and macro stats will greatly impact the stock market, setting a new trend. In other words, this week will be crucial for Wall Street. The main highlights of the week will be the publication of the U.S. Consumer Price Index for June on Wednesday and the University of Michigan Consumer Sentiment Index on Friday. These reports may provide clues about the Fed's future plans on monetary policy. If figures are better than the forecast, there will be little respite for stock ahead of the FOMC meeting at the end of the month. What's more, investors are looking forward to studying the earnings reports of US companies, especially technology giants, which have such a big influence on the main stock indices. The quarterly reports of the leading banks, namely JP Morgan, Morgan Stanley, Wells Fargo, and Citigroup, will be in the limelight. Watch our video review and stay up to date with the latest market news. Feel free to leave comments down below. Last week, traders waited with bated breath for the Fed's meeting minutes and the non-farm payrolls report. To some extent, they believed that there was a chance for a soft landing of the economy, enabling the main indices to add small gains. As usual, the meeting minutes did not contain anything new. The majority of Fed policymakers remain hawkish, voicing the need to lower inflation expectations. They are backing a 50 or 75 basis point increase in July. And following the release of NFP data, a 75 basis points rate hike looks more likely. If so, it will be second consecutive rate increase by 75 basis points. The regulator will make the final decision after the publication of the Consumer Price Index for June. In general, last week the US revealed strong economic reports, including the labor market one. It appears that the Fed, balancing between recession and record high inflation, has the opportunity to raise the key rate. The US economy added 372,000 new jobs last month, exceeding market expectations. Analysts had expected a reading of 268,000. Notably, the growth of household expenditure slowed down less than anticipated. The number of short positions in the S&P 500 index is rather high. It may indicate that the market has reached the bottom. Traders are focusing their attention on inflation data. If inflation has peaked, stocks may finally bounce from the bottom. And now let's move on to the stock indices. They managed to hold at their levels last Friday after the release of the NFP report. The Dow Jones sank by 54 points, while the S&P 500 declined by 0.1%. The NASDAQ rose by 0.1% after falling to a 4-week high. The index hit this level in Thursday sessions. As for the weekly results, the Dow advanced by 0.8%. Wall Street started a new week with uncertainty. Earnings reports and fresh macro stats may encourage the Fed to hike the key rate by 75 basis points. In addition, speculators are getting rid of risk assets due to fears about economic problems in China due to a new outbreak of the virus in Shanghai. As stocks are vulnerable to inflation data, investors are very nervous in anticipation of fresh figures. If the consumer price index in the United States rises, it might trigger a wave of sell-off of risk assets. Naturally, such a scenario is extremely bullish for the US dollar. The latter will strengthen significantly amid an increase in consumer prices. The CPI index is expected to grow by 8.8% in annual terms and by 1.1% on a monthly basis, signaling an acceleration compared to last month. Inflation is now fueled by energy prices. The average price of oil was 3.6% higher in June than in May. The CPI index is projected to amount to 5.7% year-on-year, which is slightly lower than the May figure. However, investors will draw conclusions after the release of retail sales and industrial production reports. They will provide hints about whether inflation has peaked and how it affects the economy. The S&P 500 index climbed by 2% last week. It kicked off the week with a steady decline, losing more than 1% on Monday. Inflation fears are still weighing on the market. However, there are some positive shifts. Inflation shows signs of cooling down. The personal consumption expenditure price index, excluding food and energy prices, increased by 4.7% in May in annual terms versus the April figure of 4.9%. The Fed takes into account this indicator to assess changes in inflation. The index had been slowing down for the third month in a row after rising to a high of 5.4% in February. There are more signs that inflation has already peaked. However, there are just assumptions of market strategists. They will hardly dramatically impact the index. Despite attempts to rebound, the S&P 500 is moving within the downward channel. The nearest resistance level is still located at the psychologically important level of 3,900. The support level is seen at 3,660. The index may return to 3,900, the April high of the downward channel. It's likely to decline further from this level. A rise above 3,950 will improve its short-term prospects. If so, the next resistance level will be located at 3,970. After that, the index may climb to 4,017, the high of the price gap reached in early June. The heavy tech NASDAQ 100 climbed by 5% last week, notching the biggest increase among the key stock indices. However, on Monday, it incurred the largest losses compared to other indices. Its intraday drop was almost 2%. The risk of sentiment returned to the market after the closure of casinos in Macau in more than 2 years, due to the worsening epidemiological situation in China. It pushed the NASDAQ index into negative territory. The shares of top tech companies and related companies suffered the biggest losses. A new uptick in COVID cases in China raises concerns about a slowdown in the global economy. Apple stock decreased by 1.9% after rising for 5 consecutive sessions. Analysts downgraded its fair value by more than 12%, citing market volatility and the possibility of recession in the US economy. At the same time, analysts keep the buy recommendation. The drama with Twitter shares is in the spotlight. They dropped by 11% after Elon Musk announced he was pulling out of a deal to buy the social media platform. There's still hope that the deal will be completed. There are many benefits for both Musk and bankers. If Musk refuses to buy Twitter, Wall Street's top banks will lose hundreds of millions of dollars, covering one of 2022's biggest paydays. If the deal takes place, as Twitter's management insists, then Morgan Stanley, a trusted financial advisor to Musk, along with Goldman Sachs, JP Morgan, Bank of America, and Barclays, will pocket up to $192 million in commission. Investment banks will receive commission only if the deal is closed. For this reason, bankers will do everything possible to complete the deal between Musk and Twitter. That's all for now. Subscribe to our channel and keep close tabs on market developments. We work for you by making video reviews every day and every week. See you!